While the entire world holds its breath watching every move of the Federal Reserve in Washington, a veritable economic time bomb is counting down in Tokyo, where a seemingly technical decision on December 19, 2025, could trigger the largest asset sell-off in history. We are not talking about standard market volatility here. We are discussing the collapse of a financial mechanism that has nurtured U.S. public debt for over a decade, with $1.1 trillion in Treasury bonds sitting in the danger zone, poised to crash the stock market and the AI bubble if interest rates breach the threshold of mathematical tolerance. If you want to understand how global capital flows are reversing and how to protect your assets before this financial tsunami hits, take a second to like and share this article so this critical financial knowledge can reach more people, helping our community navigate the unpredictable volatility ahead together. The story begins not with dry statistics, but with the stark reality that most retail investors in the US and globally are looking in the wrong direction by obsessing over Jerome Powell and the Fed, while the true architect of global capital flows right now is Bank of Japan, BOJ, Governor Kazuo Ueda. On December 9, 2025, Governor Ueda sent shockwaves through the global bond market by suggesting that policymakers would seriously weigh the pros and cons of raising interest rates, and within hours, the yield on the Japanese two-year government bond crossed the 1% mark for the first time since 2008. This may sound like boring central banking jargon, but it is actually the siren, signaling the unwinding of one of the largest financial positions in human history. Because Japan is not just a standard bondholder. They are the United States' largest foreign creditor, holding between $1.1 and $1.2 trillion in US Treasuries. For over a decade, the financial relationship between these two major economies has been built not merely on friendship or diplomacy, but on a solid mathematical foundation that Wall Street calls the carry trade, an arbitrage mechanism that has effectively turned Japan into a massive money-printing machine funding U.S. government spending. To understand why December 19th is a matter of survival, we need to dissect how this carry trade machine operates. Imagine being able to borrow money at negative interest rates, not cent, but negative, meaning the bank actually pays you to take their capital. That was the reality in Japan for years as the central bank held rates below zero to stimulate the economy, allowing banks, pension funds, and even individual Japanese investors to borrow yen at virtually zero cost or even at a profit from the moment of inception. Armed with that cheap capital, they executed a mathematically genius move, converting that yen into US dollars and buying US Treasury bonds paying 4% or sometimes 5% yields, thereby pocketing the massive spread without lifting a finger. Hundreds of billions of dollars flowed into this trade because the math was so obvious and the returns so attractive. It felt like free money falling from the sky, and as long as the yen remained weak and the dollar strong, this machine operated seamlessly. However, the factor turning this mechanism from a permanent feature of global finance into a ticking time bomb is the shift in monetary policy. When the Bank of Japan begins to raise rates, that source of free money suddenly becomes expensive capital. Suddenly, those Japanese investors who were once paid to borrow yen are now paying 1% or more as rates continue to climb, while they are still only earning 4% on US Treasuries, causing their profit margins to collapse severely from 5% down to 3% or lower. And that doesn't even account for currency risk, because when interest rates in Japan rise, the yen strengthens against the dollar, causing them to lose money when converting back to repay their debts, turning a trade once considered genius into a financial death trap. So, what must they do in this situation? The only mathematically rational answer is to sell. They are forced to dump US Treasuries, convert dollars back to yen, and repay their loans before the math gets even worse. This is not a choice based on emotion or vague market fear, but pure pressure from the numbers forcing them to act to cut losses or preserve capital. And we know this isn't just theory, because it is already happening right before our eyes. In the first quarter of 2025 alone, Japan dumped $119.3 billion in US Treasuries, marking the steepest quarterly drop since 2012, a terrifying pace of selling that, if sustained, would wipe out Japan's entire treasury holdings in about 2.5 years. But what is more frightening is that this process will not be gradual or smooth. It will accelerate as critical milestones hit, typified by December 1st, 2025, which gave us an ominous preview of what is to come. On that day, US Treasury yields experienced their biggest single-day spike in months, with the 30-year bond yield jumping 8 basis points in a matter of hours, and the trigger was movement in the Japanese bond market. When the yield on the 10-year Japanese government bond, JGB, hit levels unseen in 17 years, the 2-year crossed 1%, and the 30-year hit a record 3.2%. The attractiveness of keeping money at home in Japan surged compared to sending it to the US. Every basis point increase in Japanese yields translates into billions of dollars of selling pressure on US Treasuries, creating a reversal of capital flows from west to east, from America back to Japan, right when the US needs capital the most. The timing makes the situation even more ironic and cruel, as the Bank of Japan's December 19th meeting occurs the same week as the Federal Reserve's meeting on December 17th and 18th. While the Fed is expected to cut rates by 0.25%, making US bonds less attractive, Japanese bonds are becoming more attractive, creating a double pincer movement, choking off capital flows into the US just as the government is running a $2 trillion annual deficit. America needs foreign buyers to fund that massive spending, needs Japan to keep buying debt or at least stop selling. But instead, Japan is shifting from the largest buyer to potentially the largest seller. The issue becomes even more grave when politics begins to interfere with financial decisions. In May 2025, Japanese Finance Minister Katsunobu Kato stood before reporters and said something Japanese officials rarely say out loud. He stated that Japan's treasury holdings could serve as a card on the table in trade negotiations with the United States, a public admission that the debt America owes them is political leverage. Although he later tried to clarify that Japan would not sell off and would continue to support the debt market, the phrase "card on the table" when discussing $1 trillion was not a random slip of the tongue, but a clear signal that financial analysts call the nuclear option. If Japan decides to sell even 10 to 20% of their holdings for strategic reasons, the market would be flooded with $100 to $200 billion in bonds needing new buyers, a massive supply shock that would overwhelm demand and send yields skyrocketing. Christopher Myers from B-Side Capital bluntly stated that this is not an abstract financial event, but a flashing red light. Because finance ministers do not casually mention financial weapons unless political pressure has reached a breaking point. The reality is that from January 2022 to January 2025, Japan reduced its total US Treasury holdings from $1,029 trillion to $1,007 trillion, a reduction of $220 billion. But the real story lies in the acceleration of the selling. Specifically in April 2025, as political pressure from President Trump's tariff announcements increased, Japan sold $17.5 billion in bonds in just 1 week ending April 4th, and continued to sell another $3.6 billion the following week. The pattern is undeniable, demonstrating that modern economic warfare is waged not with tanks or missiles, but with sovereign debt and interest rates, where nations use their creditor status to pressure partners. When combining this political factor with the unwinding of the carry trade, we see a perfect storm forming as selling pressure comes from two directions simultaneously: the government selling for strategic reasons and the private sector selling for mathematical reasons. The American Enterprise Institute, AEI, issued a warning on December 1, 2025, stating that this unwinding process could contribute to a rise in U.S. government bond yields, which could be the trigger for the bursting of the artificial intelligence AI bubble. Let's pause for a moment to reflect on this terrifying connection, because we are not just talking about stress in the bond market, but the potential collapse of the tech stock market that has been the primary engine driving the entire market upward. AI stocks like Nvidia or Microsoft are trading at valuations of 50 to 100 times earnings, a price that can only be justified when the risk-free rate is low. But when safe bond yields spike, this valuation foundation crumbles. If the risk-free rate from government bonds rises to 5% or higher, taking equity risk to earn a 2% yield becomes insane, forcing algorithms and institutional investors to dump tech stocks to rebalance portfolios. Mathematical proof shows this has already begun as the Japanese 2-year yield went from negative in 2022 to over 1% today, a swing of more than 1% in just 3 years, causing tens of billions of dollars in losses for carry trade positions, if not adjusted in time. The nearly instant correlation between the Japanese 10-year yield hitting its highest level since the financial crisis and the spike in U.S. yields shows the market is reacting with extreme sensitivity to every move from Tokyo. Peter Bukvar, Chief Investment Officer at Bleakley Financial Group, likened it to countries with excessive debt and no control plans being watched closely by the global bond police. And ironically, the US is the debtor while Japan is playing cop. The pressure is building visibly. In early December 2025, a long-term bond auction right in Japan's domestic market saw the weakest demand since 1987, indicating that even Japanese investors are demanding higher yields to buy their own government's debt. This confirms that the incentive structure has completely flipped, as Japanese investors would rather keep money at home earning 1% than send it to the US to earn 4%, while bearing increasingly unpredictable currency risk. The mechanism is locked in and the gears are turning. Rising Japanese rates make borrowing yen expensive. Rising Japanese yields make domestic investment attractive. Shifting currency dynamics increase dollar risk, and the US Treasury market is starting to show stress cracks. The only remaining questions are scale and speed. How much will Japan sell, and how fast will the carry trade unwind? December 19th is the moment we begin to receive those fateful answers. At this meeting, the Bank of Japan has 3 options, and terrifyingly, every single option triggers the collapse mechanism in different ways, leaving no safe exit for the US bond market. Option 1 is to do nothing and keep rates low, but this would cost them all credibility as inflation pressures mount, and in reality, the market no longer believes in this scenario. Option 2, the consensus scenario, is to raise rates by 0.25% to 0.5%, a cautious step, but still enough to confirm the policy shift and signal that the era of cheap money has officially ended. Option 3 is to raise rates accompanied by signals of multiple future hikes over the next 6 months. This scenario would trigger panic and an immediate, massive unwinding of positions. But the trap many fail to realize is that even a gentle rate hike triggers the selling mechanism. Because in financial markets, trend and momentum matter more than the current level. Once Japanese investors see rates on an upward trajectory, they know the cost of borrowing yen in the future will be higher, so they front-run the move by selling now rather than waiting, creating a self-fulfilling domino effect. History shows that regime changes like this never happen smoothly. After 17 years of zero or negative rates, the entire market has to reprice decades of assumptions overnight. Let's dive into the upcoming mathematical scenario. Currently, the spread between the US 10-year yield, 4.3%, and the Japanese 10-year, 1%, is 3.3 percentage points, a margin that seems safe but is narrowing rapidly. If the BOJ raises rates 2 more times by March 2026, taking the policy rate to 0.75% or 1%, the Japanese 10-year yield could hit 1.5%, narrowing the spread to 2.8%, a 15% reduction in relative attractiveness. But the fatal blow lies in the exchange rate. If the yen strengthens from 157 to the dollar down to 145 as forecast by Evercore ISI, that is a 7.6% appreciation, meaning Japanese investors would lose money even while earning the yield differential. When that reality hits, if just 10% of Japan's $1.1 trillion in treasuries returns home, that is $110 billion sold. A massive figure compared to the absorption capacity of US primary dealers. The big banks obligated to buy government bonds when no one else will only have the capacity to absorb about $100 to $150 billion. So a sustained sell-off would completely overwhelm them, forcing yields to skyrocket to find new buyers. Citibank estimates that every $100 billion in net foreign selling pushes Treasury yields up by 10 to 15 basis points, meaning a sell-off of $110 to $330 billion would push yields up by another 50 to 100 basis points. This would take the 10-year yield from 4.3% to somewhere between 4.8% and 5.3%, and 5% is the threshold of death we previously encountered in October 2023. When yields touched 5% in 2023, we witnessed the collapse of Silicon Valley Bank, Signature Bank, and First Republic, requiring emergency intervention from the Fed to save the banking system from implosion. The 5% level is where the math stops working for highly leveraged institutions, where commercial real estate values collapse, where zombie companies cannot refinance, and where stock market valuation multiples compress violently. This time, we return to that threshold, but with a much larger budget deficit and no reliable foreign buyers to rescue us, as both China and Europe are dealing with their own issues. China, currently the largest foreign creditor, is also reducing holdings and is unlikely to buy more while in a trade war, while domestic US investors are already saturated with existing bonds. The only remaining hope is that the Federal Reserve would have to restart quantitative easing, QE, printing money to buy bonds, but that would immediately reignite inflation fears and, ironically, push yields even higher, creating an inescapable doom loop. And as bond yields rise, the AI bubble will be the first and biggest victim, because the entire valuation of today's tech companies relies on the assumption of perpetually low interest rates. If the risk-free rate is 5%, accepting stock risk to earn 2% is madness, forcing investment funds to dump tech stocks, causing widespread wealth destruction that feeds on itself through margin calls. December 19th is not just a policy meeting. It is the day the math changes forever. The day the arbitrage trade that funded a decade of American borrowing officially ends. The machine has started running. Warning signs have appeared everywhere from the Q1 sell-off to the failure of Japanese bond auctions. And the question is no longer if, but when, and whether you are ready. Japan may not destroy the dollar in a day, but they have the capability to crash the bond market in a week. And if 5% yields break the financial system like in 2023, we will look back at December 19th, 2025, as the day of reckoning we should have seen coming. In this context of historic volatility and risk, equipping yourself with knowledge and mental preparation is the most important weapon for every individual investor. So please share your thoughts and strategies in the comments below so we can discuss and find the safest path forward together.